the topics here. It's titled Long-Term Liabilities, Bonds and Notes. And some of the topics include the impact of borrowing on earnings per share, talking about the characteristics and terminology for bonds, journalizing entries for bonds, talking about installment notes, describe and illustrate the reporting for long-term liabilities, and then also discuss the number of times interest charges are earned is used to evaluate a company's financial condition. So basically a ratio is what we'll follow up with or finish with. Let's talk about the impact of borrowing on earnings per share. So corporations finance their operations using a few sources of cash, short-term debt, such as purchasing goods or services on account. Quite often you buy goods or services on account from another business, and as long as you repay within 30 days, there's no interest or anything like that. Long-term debt by issuing bonds or notes payable, so long-term is anything more than a year. And then equity, such as issuing common or preferred stock, which we talked about in the previous chapter. Just be aware that a bond is a form of an interest-bearing note. Okay, like a note, a bond requires periodic interest payments, and the face amount must be repaid at maturity. Huckabee Corp is considering the following plans to issue debt and equity. You can see they've got three options. Basically, Plan 1 is just to issue stock, basically $4 million worth of stock. Plan 2 is to issue a combination of preferred stock and common stock. And Plan 3 is to issue a combination of bonds, preferred, and common stock. So three options to raise $4 million. And it says, in deciding among the financing plans, the effect on earnings per share is often considered. We know what earnings per share is from the previous chapter. You can see the formula there is the same one we had then. Net income minus preferred dividends, if there are any, divided by the number of common shares outstanding. So when we say earnings per share, we're thinking earnings per share for common stock. Assume the following data for Huckabee Corporation: earnings before interest and income taxes are $800,000. The tax rate is 40%, and all bonds or stocks are issued at their par or face amount, which makes it easier to analyze. So the three plans then, you can see here how the three plans impact earnings per share. And just know that Plan 1 was for sure going to be the lowest, because if we have more shares of stock outstanding, earnings per share has to go down. Same with Plan 2, because of the number of shares of stock we're issuing, earnings per share will go down. Plan 3 would be the highest EPS because now we're using debt to raise half of that $4 million number. Okay. And then here this says basically, and that previous screen was earnings were $800,000, and this screen just says what if earnings were $440,000. Then it's a little bit different answer, by the way. And you can just kind of walk through the calculation. I'll go back to the previous example. So basically you can see what the earnings are before interest and tax, deduct interest on bonds, because interest of course reduces earnings, and then of course we have to deduct the income tax, which is 40%, to get down to net income. And for Plan 1, we have a decent net income number, but because we issued so many shares of stock, we get the lowest EPS. For Plan 2, that was a combination of preferred and common. We get $480,000 net income, but we have to subtract dividends on the preferred stock, which only leaves $300,000 divided by 200,000 shares. And for the final one, because we use debt, that kind of helps us a little bit. Debt requires the repayment of interest, so we're going to have to make an interest payment, which reduces net income, but we didn't issue as many shares of stock, so therefore my earnings per share was the highest. But in the previous example, when our earnings are $440,000, we get a little bit different answer. So this is just kind of one of those things that a company will look at. They'll look at what their current earnings are, determine what the best source of financing are, and look at how that will impact earnings per share. So bonds payable is the next thing to talk about. The underlying contract between a company issuing bonds and a bond holder, basically whoever bought the bonds, is called a bond indenture. Usually the face amount of each bond is the principal, is $1,000 or a multiple of 1,000. Interest on bonds may be paid annually, semi-annually, or quarterly. Typically it's semi-annually, just think every 6 months. When all bonds of an issue mature at the same time, they're called term bonds. If bonds mature over several dates, they are called serial bonds. And bonds that can be exchanged for some other security, typically common stock, is called a convertible bond. Bonds that a corporation reserves the right to redeem before maturity is called a callable bond. Basically, the corporation that says we can call the bonds back at a certain price, and you have to sell them back to us at that price. Bonds issued on the basis of general credit of the corporation are called debenture bonds. So basically, really only backed by the name of the company and no specific asset. So lots of terminology in these two screens here. So just be aware that terminology will definitely be coming up on a test or a quiz. Proceeds from issuing bonds. When a company issues bonds, the proceeds are received. And how much is received depends on a few things. The face amount of the bonds, which is the amount due at maturity, plus also the interest rate on the bonds compared to the market rate of interest for a similar bond. So that just so you know, the market value of a bond is very much influenced by interest rates. And interest rates change all the time. So the price of a bond will change based on the market rate of interest. And you compare the market rate of interest to the face amount of interest, and that will affect the price of the bond. So basically the face amount and the interest rate on the bonds are identified in the bond indenture, just what is basically stated on the contract. And that would be your contract rate or coupon rate. Okay, so basically it's printed on the actual bond certificate, the contract rate, also called the coupon rate. The market rate of interest is essentially the effective rate of interest. It's determined by transactions between buyers and sellers of similar bonds. The market rate of interest is affected by a variety of factors, including investors' expectations of current and future economic conditions. So basically, general economic conditions impact market interest rates, including policies by the Fed, foreign governments, what's going on in the economy of the world generally. Lots of things impact interest rates that nobody can really control. But basically just know that the market rate of interest compared to the stated rate of interest will impact the value of the bond. So if for the same number, the bond will sell at its face amount, a $1,000 bond will sell at $1,000. Let's just say the market rate and the stated rate are both 10%, the bond is worth its face amount. In the next example, if the selling price is less than the face amount, basically then the bond will be sold at a discount. So up here, I guess it should look at the top of it here. If the market rate's greater than the contract rate, so basically the market rate of interest, let's just say it's 11, okay, and the contract rate's 10. So basically that bond is negatively impacted because the bondholder could go out and buy a bond just like it for 11%. So why would I pay $1,000 to buy this bond and only get 10% when I can get 11% somewhere else? I'm not going to spend $1,000 to buy the bond. Well, somebody's still willing to buy the bond, but they were only willing to buy it at a price less than the face amount. So sell that bond at a discount for less than $1,000. And so the flip side happens, of course, when it's sold at a premium. So if the market rate's greater than the contract rate, so now let's just say the market rate, going back to that, the market, in the previous example, actually, man, I might have said that backwards. Let's just say the market rate, greater than contract rate, then discount. And here it is, the market rate less than. I got that backwards in my head for a second. Let's say the market rate's less than the contract rate. Okay, so the contract rate, let's go back to it's 10%. But the market, let's just say, is 9%. So our bond looks really good, right? Because the market says you get 9%, but our bond says, no, we'll pay you 10%. So investors will want our bond, and so therefore they will pay more than $1,000 to acquire that bond. They'll buy that bond at a premium. So just be aware of that terminology of premium, discount, and par. These 3 slides. There's good info in the book. Take a look at that. That will definitely also help you. So we sell a bond. We're a company. We're going to sell a bond. Again, if we sell it where the market rate equals the contract rate, we receive exactly the face amount. If we sell that bond for less than the face amount, we sell it at a discount. If we sell that bond for greater than the face amount, we sell it at a premium. And so also just know that the price of a bond is quoted as a percent of its face value, so typically a decimal. So when you say 0.98, that's a discount. So 0.98 times 1,000 means that the bond is sold for $980, and one right below that, when it's sold at 1.09, that $1,000 bond is sold for $1,090. So entries for bonds payable, we always have entries, it seems like. So here we have an example, January 1, 2013, Eastern Montana Communications will issue some bonds, $100,000 face amount, 12% contract interest. Basically it says interest is paid semi-annually, basically twice a year. Term of the bond is 5 years, market rate's 12%. So notice the market rate and the contract rate are the same. And so we're going to sell that bond for exactly its face amount. So we'll debit cash for $100,000, credit bonds payable for $100,000, and we've now recorded the issue. Then every 6 months we'll pay interest. We'll pay interest based on the formula of principal times interest times time. So principal of $100,000 times interest of 0.12 times half a year, 6 out of 12 months, means every 6 months then, for the next 5 years, I'll make this entry to debit interest expense and to credit cash. When the bond matures, I repay the principal, so then I would debit bonds payable and credit cash. Okay, so that's the very basic, simple bond issue, bond interest, and bond repayment entries. Now let's look at selling the bond at a discount. So different example here. Now we have Western Wyoming Distribution issues a $100,000 bond, 12%, 5 years, when the market rate was 13%. Interest again paid semi-annually. These bonds will be sold at a discount because the market rate's 13, but these bonds only pay 12. Therefore, investors are not willing to pay the full amount for these bonds. They'll pay an amount less than $100,000. So the firm issued the $100,000 bonds for $96,406 at a discount of $3,594. So notice that we still have debits of $100,000. We still have a bond payable for $100,000, the face amount. That never changes. We still have to credit bonds payable for the full amount. It's just that we did not receive $100,000 of cash. We received $96,406, and that makes up for that 1% interest difference. And we debit the account called discount on notes payable. So we then have to amortize that discount on notes payable over the life of the bond. We have 2 methods we can choose, the straight line method or the effective interest method. Okay. Both methods amortize the same amount over the life of the bond. It's just that each method will take a different amount per payment to get there, but in total, over the next 5 years, the full amount of the discount will be amortized away. The effective interest rate method is required by general accepted accounting principles. However, straight line method may be used if the results do not differ significantly. And also, some companies that maybe only have a little bit of bonds might just use straight line. But companies that have a lot of bonds where it would be significant would definitely use the effective interest rate method. So amortizing bond discount then, so we're going back to the Western Wyoming company. So 6 months after bond issue, we now are going to record the first interest payment. And we credit cash based on principal times interest times time of the stated amount. So the stated amount was a $100,000 bond. Stated amount of interest is 12% times half a year. 6 over 12 is $6,000. Okay, so I'm going to write a check for $6,000 to pay interest, but my interest expense is higher than that because of that discount that I have to amortize. Okay, and so basically with the 5-year bond, paid twice a year, that's 10 payments. Okay, and so we're just going to say, okay, for the total discount is $3,594. Let's just take 1/10 of that every payment period and record that discount on bonds payable. The goal is that when the bond matures in 5 years, which is 10 payments, that discount is gone, because the original entry was a debit to the discount, and every time we amortize it, it's a credit to the discount, so it'll be gone by the time the bond matures. Now another one, basically a premium example. So now we've got Northern Idaho Transportation, same situation, $100,000 bond, 12%, 5 years. But now notice the market rate of interest is 11, but our bond pays 12. Therefore, our bond is more valuable. People are willing to pay more than $100,000 to buy it. And so we'll debit cash for 103,769. We still credit bond payable based on the face amount of the bond, 100,000, and we credit the premium for the difference. Entry to record the first interest payment and the amortization of the premium on the $100,000 12% 5-year bond. So basically 6 months from now, let's record the first interest payment. We credit cash based on the principal times interest times time, the same $6,000 we've had before. We debit the premium now, basically for 1/10, and then we debit interest expense. And notice that this reduces interest expense. It's less than $6,000. Bond redemption, we mentioned earlier that a corporation may recall, redeem, or redeem bonds before they mature. A callable bond can be redeemed by the issuing corporation within the time period stated on the contract, basically, at a call price. Typically, that call price is above face value. The carrying amount of bond payable is the face amount of bond less any unamortized discount or plus any unamortized premium. A bond redemption, a gain or loss may be realized on a bond redemption as follows. A gain is recorded at the price if the price paid for the redemption is below the bond carrying amount, or a loss is recorded if the price paid for the redemption is above the carrying amount. So it can be a gain or a loss. Bond redemption, then let's talk about we're going to redeem a bond. The corporation that issued bonds earlier is now going to redeem them and basically buy them back. So June 30, 2013, we had issued bonds of $100,000, which is unamortized premium of $4,000. Basically, the corporation redeems 1/4 of the bonds for $24,000. And so you can see we're going to credit cash for $24,000. We'll debit the premium for $1,000. It's basically 1/4 of the bonds, so that's 25% of that's $1,000. And we debit $25,000 for the bonds payable, and then we credit the gain. So basically, that gain is the credit is the balancing amount. Okay, so we know we have to debit bonds payable for $25,000. We know we have to reduce the unamortized by 1/4. We're paying cash at $24,000, so to make it balance, we credit the gain for $2,000. Bond redemption, to continue that, the corporation calls the remaining $75,000, which are held by a private investor. They pay $79,500 to redeem those. So we credit cash for $79,500. We debit the bonds payable for $75,000. We have the premium left over, $3,000 to reduce. And now to make it balance, we have to debit the loss account. Okay, so basically we're just comparing book value given up to the price we paid to settle the claim. Difference is gain or loss. So we'll talk next about installment notes. An installment note is a debt that requires a borrower to make equal periodic payments to the lender for the term of the note. Unlike the bond, the note payment includes the following. Payment of a portion of the amount is for principal, and then payment of interest on the outstanding balance. So every payment will represent both principal and interest, unlike a bond where we only make the principal payment when the bond matures. We make interest payments until then. So installment notes are often used to purchase specific assets, such as equipment, often secured by that purchased asset. When a note is secured by an asset, it's called a mortgage note. If the borrower fails to pay the mortgage note, the lender has a right to take possession of the pledged asset, basically as the protection for the lender is that they can basically seize that asset. Lewis Company issues a $24,000 6% 5-year note to City National Bank. Annual payment is $5,698. So we basically borrow money and we debit cash for 24. We credit note payable for 24. It says issued installment note for cash. We then begin to make the annual payments, and then notice that each payment represents a portion of it is interest and a portion is principal. Okay, so basically we take that carrying amount of 24,000 times 6%, and that's for the full year, and we get interest of 1,440. The payment is 5,698. So basically 5,698 payment minus interest of 1,440 equals column D, which is the principal payment. And so column E is basically column A, 24,000 minus the principal to get down to what's left over, 19,742. So basically this works out then when the final payment is made on December 31, 2017, that liability then goes down to zero. So basically all the principal is repaid. Okay, so we're kind of just showing here how we got to each of those parts. The journal entry to record the first payment then, once you got that schedule, it's really easy to just look at that schedule and say, okay, I make a payment of $5,698, 1,440 is interest expense, the rest is principal, 4,258. And then we just keep doing that every year. We kind of make the same entry. The credit to cash is the same, but the split to interest and notes payable changes a little bit for each of the years. And here is getting towards the end. There's very little interest. So the last payment has the least amount of interest, the most amount of principal. And if anybody's seen basically a schedule for a car loan, for a mortgage, it kind of works the same way. The first few payments, interest is really high, principal is small. The last few payments, it kind of flips around the other direction. Okay, let's talk about reporting for long-term liabilities then, in terms of what it looks like on the balance sheet. So here's a balance sheet. We show a bonds payable, and notice that we show the bonds minus discount to get to book value of 484, and also a note payable. So just a very common slice and dice there of a balance sheet with long-term liabilities on it. Next we'll talk about times interest earned, a very common ratio that you look at basically to determine the ability of a business to repay its bondholders or note holders. So basically you're looking at your income before income tax plus interest expense. So basically your income before tax, add interest expense to that, then divide that by interest expense. And the greater that number, the more ability you have to repay your interest expense. I'm going to talk just a little bit about present value, but I'm not testing or quizzing you on this at all. But just know that basically we just kind of just gave you everything so far. When it had a bond or a note, we didn't make you come up with present value or anything like that. But obviously, if you are issuing bonds, the price investors are willing to pay for bonds depends on the following: the face amount in the bond, and then basically what the interest is and the market rate of interest. So basically the bond compared to the market rate of interest compared to the stated rate of interest, and that all basically impacts the value of a bond. So time value of money recognizes that amount of cash received today is worth more than that same amount of cash in the future. Okay, so present value is the current worth of a future sum of money or stream of cash flows given a specified rate of return, and the amount to be received in the future, if you make the deposit now, is the future value. So basically, let's think of it this way. Let's just say I'm saving for a new car, okay, and I'm going to put money aside to save for that new car. Let's just say let's just say I'm going to put down $2,000 a year for 5 years, okay. That's $10,000, which is not a new car, but let's just kind of give you a feel for it. And so if I do that in 5 years, I have $10,000, obviously. However, if I get a rate of return when I put that money down, so let's just say I take that $2,000 and I put it into some kind of investment that gives me 5%. Okay, so 2,000 that first year we earned 5%, so I'm going to earn more than $2,000, and so basically that money after 5 years will be worth more than $10,000. So I'm going to save money now and be worth more in the future. Okay, that's future value. Or let's just say, okay, I need $10,000 5 years from now to be able to buy a new car or put that money towards a new car. I don't need to have $10,000 today, right? I can save an amount per year less than $2,000 a year to have it worth $10,000 in the future. So that's what they mean by time value of money based on interest rates. So if I need $10,000 5 years from now, that doesn't mean I have to set aside $2,000 a year for 5 years. I can put an amount less than that aside as long as I'm earning a return. It'll be worth $10,000 in 5 years. So that kind of just gives you a picture of it here. So a $1,000 10% bond is purchased. It pays interest annually and will mature in a year. And so basically that bond is worth, present value of $1,000 received 1 year from today. Then 1 year from today, it's basically, we're going to get $1,000 at 10%. So you look at what they call a present value table. And your book would have these towards the back. And so it says present value of $1 at compounded interest. And you see the 10% at 1 year, 0.90909. So if I take 1,000 times 0.90909, so that $1,000 in a year at 10% is worth $909.09 today. So if I put aside $909.09 and earn 10% on it, in 1 year it's worth $1,000. Let's just say now we have a bond that pays 10% annually and will mature in 2 years. So we look at the table again, and we look at 10% in 2 years. Now we get 0.82645. And we go 1,000 times 0.82645, we get $826.45. So today at 10%, for 2 years, it'll be worth $1,000. Okay. A series of equal cash receipts spaced equally in time is called an annuity. The present value of an annuity is the sum of present values of each cash receipt. And that's what the interest on a bond is. It's really an annuity. So it says assume that $100 is to be received annually for 2 years, and the market rate of interest is 10%. So that's basically my $1,000 bond at 10%. That means I'm going to receive $100 worth of cash annually for the interest payments. The next slide illustrates the present value of the amount of 100 at 10% for 1 year, and the present value of 100 at 10% for 2 years. And so you can see how that turns out. So basically, what that annuity stream is worth. At 1 year, it's worth $90.91. At 2 years, it's worth $82.64. And then the sum of the two is $173.55. So the present value of the periodic receipts then, with the present value of an annuity, a series of cash receipts at fixed intervals is involved. The present value of an annuity of $1 at compound interest can be used. And so we can just look at factors to do that, just like we could before. And so this is a different table, but kind of the same thing. 10% 2 years, I get a factor of 1.73554. Multiply that by my $100, and I get 173.55, which is what we had 2 screens ago. We had 173.55 right there at the bottom. And so pricing of a bond works much like that. And so it says Southern Utah issued a $100,000 12% 5-year bond on January 1. The bonds pay interest semi-annually on June 30 and December 31. And so we just have to look at our table and go, okay, the present value of the face amount of $100,000 due in 5 years, 12%. And this is, now keep in mind, it says market rate is 12%. But we're looking at 6% because the bonds are semi-annual. So we have to divide the interest rate by 2. Okay, and so that's the first part of that. And the second part is because it's 10 payments, basically it's a 5-year bond, but with 10 payments, so we use 10. So we go 6% at 10 is my factor of 0.55839. The present value of the face of the bond is $100,000 due in 5 years is $55,840. So next we need to determine the present value of 10 semi-annual interest payments of $6,000 at 12% compounded annually. So again, it's 10 payments, 2 a year for 5 years is 10. And it's because every 6 months we take the interest rate that's annual at 12%, becomes 6% semi-annually, and we get the factor as 7.36009, and we multiply that factor times these $6,000 payments to get 44,160. And so the value of the bond is made up of two things: the present value of the $100,000 in 5 years, and the present value of the semi-annual interest payments becomes $100,000 because the face amount of the bond was the same as the market rate. And of course, we could do the same thing then if they're different, and we can just kind of follow the same pattern, only this time at 11%. So we get 5.5, basically, if we divide that by 2, and so on. Okay, and that gives us a new amount. Okay, you can see what that is. Then the last appendix dealt with the effective interest rate of amortization. We really just did the simple rate in the example earlier. And so it says it's called the interest method or the effective interest method. Provides a constant rate of interest over the life of the bonds. And so when we do that, we put together a table like this where we always pay the same amount of interest per period, $6,000. Interest expense was based on, in this example, the discount, the interest was 13%. So basically at half, it's 6.5%. So 6.5% of 96,406. The discount amortization is right here. Unamortized discount is here, and the carrying amount of the bond is right here. So basically, once the 10 payments are made, the bond carrying amount is $100,000. And notice that the discount taken goes up with the passage of time. And so here's just a journal entry, the same entry we looked at earlier, only now using the effective method. And the same thing applies using the premium here. You just get a table that looks like this. And you get this entry here. So just be aware that when you use the effective method, you do more of a table like this, which a lot of companies that have a lot of bonds, either bonds as investments or bonds payable, will use software that'll just generate this, or you can set up an Excel spreadsheet really easy to do the same thing. And that was the end of the bond and notes chapter.